Michał Konarski, mBank. If we could talk a little bit more about the net interest margin and actually more about interest expense of Bank Millennium in the first quarter. Looking at the net interest margin, it dropped 0.1 percentage point quarter on quarter, and it seems that the bulk of it actually should be attributed to the interest expense of this net interest margin drop. And I was just wondering, there was retail deposits gathering in the first quarter. You've got pretty good situation in terms of the loans to deposits. Why was the decision to start gathering the deposits, given such a good situation with loans to deposits, and what we should expect going forward? Should we expect that the net interest expense, interest expense should still be growing over the next quarters, or we should see some stabilization and thus some margin rebound going forward in the next quarters? Thank you.
I must confess, I know that you are, all of you are big fans of net interest margin, but I must confess that we are more fans of net interest income. So it's, for us, the combination is important, and sometimes the volumes also matters, and not only what we will be making by unit, so not only the margin. It's true that we are, let's call it even over liquid, and that's why we have not been growing in terms of, I would say, time deposits of corporate side. We have been performing quite well. We don't show these details, but we have been performing quite well in terms of current accounts of the corporate, but we are not doing nothing special in terms of time deposits of corporate. When we are going for more the small savings, let's call it in retail, even if we don't need this liquidity, we see it as a long-term relationship building with the customers. We realize that we have a little bit more pure retail deposits than our natural market share. We see these when we pay a higher cost in terms of guarantees of guarantee fund of deposits, because it's seen as a low deposit, so below the 100,000 euros. So it means that it's really mass retail, and we want to keep building these. So here we have a long-term also goal of building a strong market share of deposits of individuals, independent of the needs of financing for lending. Of course, there is sometimes a price to pay when we are capturing volumes, and there is a strong expectation that later on we are able to reverse these to more profitable products or to more, let's call it, less aggressive pricing. There was some increase on the pricing of time deposits in the end of the quarter last year. I think I comment this even when we talk about the annual results. And then there was not this decrease in our case, so there is this, I would say, there's this increase of the market prices in terms of time deposits with our own campaign. Our own campaign effect, we are going to reverse the total market costs. Let's see it, because we also see it a little bit at a higher price that is paid in time deposits in the market, although the expectations is that there will be flat rates even for longer time than the 1 year ago, but I would say these.
And just to add that we should not forget that these campaigns usually are valid for 3 months' time, right? So we are not saying that we are not going to continue with the campaigns, but we are just saying is that each campaign for each customer has a validity of 3 months. And there are always some adjustments that can happen, so not necessarily this small increase of the average cost of deposits is going to continue. It will depend a lot on our strategy and the management of of the cost of this campaign. But the campaign was really successful. It helped a lot the growth of the deposits during the first quarter, and I think this is good news. And also looking more for the future, the excess of liquidity that we have currently, of course, somehow it's not the most optimal structure to maximize net interest income. It's true, but on the other side, gives us a lot of room for future growth without any restrictions, both on liquidity and capital side.
Łukasz Jańczak, IPOPEMA Securities. Could you explain the significant increase in new cash loan sales? Did you change your risk appetite, or maybe are open more to external client base? Thank you.
No, we are at the level that we always wanted. So several quarters I was saying that our goal was 250 per month, although we were not achieving at all. Now we achieve this. We are surprised at how fast it was. We don't have a reason for that. We are doing the same things. We are doing, the risks are the same. Mainly there was a growth in terms of new to the product customers. So customers that they never had a loan with us. I can tell you, so that new to the product customers, so the customers that are making the first cash loan with us, 80% of them are with a relation higher than 1 year. So our customers used to work with us. And 30% of them never had a loan. So 70% of them don't have an active loan, sorry, 70%. So it means that 30% have a loan elsewhere. So we are quite happy from the risk side. So this is good news. Why this is working so fast in 1 quarter? We think it's the retail network have this a lot. So it's 3,000 individuals. So when they start to work, it's 3,000 at the same time. We trained a lot last year. Last year we were training a lot. Also we start to advertise for the first time. So probably there is also this media impact. We saw this growth in terms of mortgage 3 quarters ago. So it was the second part of last year. We saw the growth of the mortgage, and we stabilized on this is 750. And we are stabilizing, so we didn't saw a drop in the other months. So it looks like we are going to stabilize at these levels in cash loans, which is very good news, because it really shows that we will be growing in terms of lending, and this will be positive. Of course, we need to have the impact of the decrease of Swiss franc portfolio. That also there is a natural part that is by decreasing of the FX rates, but also there is an active role in our part trying to early amortize as much as possible. So we will have these two impacts, but we believe that they will be very positive.
Dariusz Górski, BZWBK. I'd like to discuss with you the relative dynamics of revenues and cost. They're almost the same, and they were not before. And within this context, what are your thoughts on the cost growth outlook? Your wages grew by 9% this quarter.
Although in percentage they are the same, the bases are not the same. So at least it will increase a little bit the result. If I would give a guidance, which I don't give, I would say that I'm more optimistic on the growth of the revenues, and we think that there will be somehow a reduction of the growth pace of the costs. So it's like this. But we never had, and you know it very well, that we never had a big focus in specific cost cutting. So it's even when we reshaped the network, we were more looking for the customer trends and the change in demography. We never were going through a cost cutting process just for that. And we really believe that the strategy of this bank is based on growth of revenues, maintaining the cost structure. Of course, it's very difficult to maintain the cost structure when you are in a country that there is zero unemployment and the salaries are growing at 7%. So it's very difficult, because even in the administrative costs, a lot of cases we are talking about personal costs inside of the contracts of the administrative costs, because you are talking about security, clearing, postal distribution, cash management and transportation. So you are always talking about a lot about services that have a huge personal or labor component, let's call it like that. But we think that we had very strong results in terms of business results, but that as we live not only by the sales but also by the stock, the impact in terms of income will accelerate. And we believe that the impact in terms of costs will somehow decelerate, even growing, but at least in percentage base, we hope that will decelerate.
And the second question, thank you very much. Second question on the cost of risk. Is this COIM provision, is this a thing that will stay forever? I mean, 7 mil approximately. So this is first question. Second is, isn't it a little bit, I know you're learning IFRS 9. I mean, everybody is. So what are your initial thoughts? I mean, shall we expect a 40-odd basis points cost of risk going forward, assuming conditions are the same?
So about this first question, so we will have now this adjustment done of interest going through provisions, but also its release will also go through provisions, right? So this may, through time, could slightly decrease the overall provisions, but I don't think it will be a major difference in terms of the overall level of provisions. I think regarding the implementation of the IFRS 9 standard, as you say, and as we said today in the morning to the journalists as well, we are still in a learning process, and this first quarter, where the standard was introduced, was a quarter where we did not see any relevant deterioration in any of our relevant portfolios, and so it means that it's not the ideal quarter to assess the implications of the implementation of IFRS 9, right? Because in a quarter where nothing happens, it's difficult that the IFRS 9 forward-looking, let's say, impacts will be visible, right? So that's why I think we should not just jump to the conclusions that just because the one quarter was low, that all the quarters will be like this. We also cannot forget that there was an initial adjustment in the level of provisions on the 1st of January, which is not shown in the P&L, it's shown through equity. All the banks had these adjustments, some more, some less, but all the banks had, which also, you know, somehow can also, in the very short term, can also limit the negative or the volatility of the provisions. But I think it's still too early to take a conclusion regarding the final impacts of IFRS 9. What we can say is, so far, we don't see relevant deterioration in the core portfolios, meaning corporate loans, consumer loans, FX mortgage even performed better than in previous quarters. The same, PLN mortgages also very well. So we did not see any deterioration, and as a consequence, we had finally these 44 basis points, which nominally, it's not much below what we had 1 year ago, right? Because it's only 5 million less than what we had one year ago. But we still think that we should somehow, in the medium term, or let's say, somehow come back to these levels of around 50 basis points where we were for a long time under the previous standard. So of course, in the short term, we are not seeing anything bad, but we will be learning with the standard, and the standard will be more volatile as well. I think what is good is that with the new standard, we were able to have not only low cost of risk, but also reduce the ratio of impaired loans over total loans. Of course, there were also some write-offs in the quarter, but still we managed to be again below this 5%, let's say, threshold. And additionally, the level of coverage, right? Because we are using also the level of coverage. Using total provisions over stage 3, 76%, we think is a good coverage.
More questions? Yeah.
Have you considered leaving some portion of 2017 net income undivided? Because we have evidence of some banks, let's say this year, paying dividend from the 2016 net income. Don't you see any upside coming from this?
No, our decision was straightforward and clear, so we did not split. So the decision was to fully retain the net profit in own funds. So we will not come back to the distribution of the 2017 net profit.
Going forward, would you consider, let's say, leaving some net income, some earnings undivided, so that you can pay this dividend later?
We may consider. I think, but most important for us is to create the conditions to allow coming back to normal dividend distribution. I think this is the most important. And we have to the methodology is known, because KNF very early this time announced the principles for the dividend policy. So assuming that they will stay the same, at least for 1 year, we know what are the rules, and so everybody knows what we should fulfill in order to be eligible to pay some dividend from 2018 results. Of course, the threshold is not the only, it's also important. Every year there is an update of the capital thresholds, so we also cannot forget about that. But we know which is the way to go in order to create conditions for the distribution. We don't know if it is going to be already from the 2018 net profit. We cannot guarantee that. But it is visible that we are going into the proper direction, because one of these criteria, this share of FX mortgage in total, is decreasing. We are now at 29%. It also depends a lot on the pace of amortization of this portfolio, but also on the growth of the remaining portfolios, how fast we can dilute it to get to the next threshold of below 20. It will not happen this year organically, but we know the direction, right?
About the acquisition of deposits, how long should it last? And what? Because I think that you are currently having some attractive offer for clients. What time does it expire? Or what time the cost of funding can go down for you? At what period?
To know when the cost will decrease, it's difficult. We believe that this will slow down now. But this does not mean that we are going to stop what we are doing commercially, because commercially we think that makes all the sense, and we believe that we are building a stronger franchise for the future, and this will go in parallel with all of this development in lending, and we think this is a good strategy. And we think that it's in universal banking is impossible to try to maximize the sweet spot in everything at the same time. So it's important to have these trends, this momentum of growing, and especially if you want to have a strong, small retail, typical saving, you need to do it this with time.
Maybe one follow-up question from me regarding the sale of the cash loans. What trends do you see in terms of the pricing of the cash loans? Then do you see any deterioration of the pricing or stabilization? If you could tell us something more.
Yeah, we see two situations. So it's somehow there is a small deterioration, I would say. And I think because there is a huge trend of all the universal banks trying to sell more and more cash loans, and so the more consumer finance type of banks, they need also to compete. One part, I think it's not a big issue. So it's like you need to give better prices to the customers that you know well, and then if you go to these new to the product type of banks and ratings 5 to 6, so then it's great. Then I think it is you are making lower price but much better risk. So the gains are they are very positive. The problem is more on these strong consolidations campaigns that we are seeing. And here sometimes there is also a price effect, and here they can be a little bit worse because then you are putting some customers that have 11, 10, 9 ratings, so it means that the risks are higher and you are still making big tickets. So I would say that I see some deterioration of pricing. But for us, we are not concerned because, as you know, we work more with our existing customer database, and also there is a very strong momentum in the economy. So it's I don't see big concerns for us, and maybe even for the market, because there is a still strong momentum in the Polish economy. So I don't see a huge increase of impairment. So it's not a risk, but there is some decrease on pricing, I think, yes. Not huge, but because we are kept at 10% maximum interest rate, I think it's still okay.
But could you actually quantify what is the margin pressure, let's say, for the last 6 months? Let's say on your products, what was the offer 6 months ago and right now?
No, I think we can answer in the following way. For this growth, we had the contribution of different drivers. One of them was a promotional campaign, relatively simple on one side, but which had implicitly a little bit lower interest rate versus what we were doing previously in terms of origination. So this is one thing. But this is not bad, especially when we are getting new customers to the product or consolidating exposures that our customers had elsewhere. Right? Because, we cannot assume that we are able to, at the same time, to get those loans or to consolidate those loans at the same pricing levels of everything that we had before. It's not realistic to assume that. There is always, in order to attract these customers, we need to also to have a more attractive pricing. So for this small decrease of the overall remuneration of the cash loans, we have on one side the effect of the promotional campaigns, second of these consolidation initiatives that in which also we need to give a more attractive overall interest rate. But this depends also a lot on how important are each of the drivers for the overall origination. I think that the success of recent months was mainly the fact that with one promotional campaign especially, we were able to attract more loans that we would otherwise do, and we believe that this additional volume, even if with a little bit lower pricing, is much better than to preserve the old overall pricing, but with a much smaller volume. If you remember, in previous, there were quarters in which we were originating 500, 600 million zlotys of cash loans, but when you looked at the overall portfolio, it was not growing significantly, right? Because as we grow, the pace of amortization of the existing one also starts to weigh on the overall growth. This time we are able to show still a 12% growth year on year, which is, I would say, very good. And additionally, according to some market indicators that in the meantime we also started to look more closely, we are getting a higher share of the origination of new consumer loans than what we used to have 1 year ago. In recent months, we had a share of origination above 5%, which is unusual for us, because usually we had around 4% a share of origination. Again, it's just a few months, but it's a good sign. This is one of the good signs that we see in this growth. It's not only the volume, it's also that our share of the overall origination of the market grew in recent months, and of course we are focused in keeping that.
Okay, and did you maybe loosen a little bit your credit risk requirements for the clients? No? No? Okay, and very last question, I promise. Regarding your very good capital position, do you think about some acquisition in terms to utilize excess capital and not to chase the requirements by KNF? Because you never know what will happen actually next year regarding, for example, the Swiss franc buffers and other things. Yeah.
I was still thinking about acquisition in cash loans.
No,
but,
no.
no.
Thanks.
Listen, the strategy was presented in due time, and even now we always present also the strategy that we presented 3 years ago. So to really be clear about what we were saying in every 3 years block. It's true that for the first time we are saying that our focus is organic, and we take a look about opportunities. And this is so it's not, and this is new. We used not to say this. So we are saying this for the first time. So it's of course we need it. We think that the fit needs to be very, very well done, because then we are talking about we are acquiring. We acquired last 3 years 300,000 customers. 300,000 active customers is almost a small bank. We have in our targets for the next year 600,000 customers. So this is, and of course, you know that, I think we already explained here that under our studies, you need 4 years to the customers to mature. So when we are talking about acquiring 600,000 customers, to have the impact of it, what it would be already a reasonable small bank, we need to wait then 4 years. So it takes time, of course, but at least we are starting to mature the customers that we acquired some years ago. It means that we believe that the strategy that we have now is enough to deliver the growth and the profits that we compromise ourselves. If there is something that is at the right price, that is fit in terms of the strategy, that is value added, that is not dilutive but accretive, then we will see. But just one question about the cash loans, because I think it's important. Please remember that our models are somehow quite. It's not easy for us to change our models, because even we are IRB and everything. So for us to change models, it's a process that also involves, if it is of course a significant change, but needs to have approvals and everything like that. So it's not. And we are more dependent on models and in the pre-approved offers than we are. We always explain here that we are not very good to attend to a customer that appears in the street. So we are not very good in the normal income process that person appears. So we are quite good is to analyze what the customers are doing with us.
And maybe on cash loans, if I may. About distribution channels, do you see any change in where you originate these cash loans, whether online or pre-scoring or branches, or has anything changed last quarter?
So from one side we keep a big part of cash loans originated online. So it's or at least that they start online. They are 37%. Yes, 37% of the cash loans are started online or via mobile, so they can end up by a courier or something, but which is a good percentage. But I must tell you that we are also happy because a lot of the new acquisition that we were doing, they also come from the branches, and this was very good. So what is happening now is that we have a kind of a process that we are moving more and more the easiest sales to the easiest channels, and so it's always a challenge, because it's like from branches to call center, from call center to internet, and even now is from internet to mobile, or from and these so it's, as you know, we are mainly operating for ourselves. We are considering now to make some tests in the future with some third parties, but it's something that we are still thinking about if we are going to do or not. So the acquisitions of cash loans is our own network. Yes, and that's it.
Marta Czajkowska-Bałdyga, Haitong. Just follow up on your cost of risk. If you could help me understand what happened this quarter with your retail cost of risk and provisioning. Was there any change in the models? Was there a sell of the portfolio? Why is it so low? Why it dropped? Maybe just, was it on the mortgage side more or on the consumer lending side?
So, first, on one side, we had, in part of the mortgage, even we have a small release of provisions during the quarter, because in fact, the portfolios have been performing better even. And so there was even slightly negative. I can tell you, for example, in the FX mortgage portfolio, the cost of risk was negative in the first quarter. But still, even with these, even there were some provisions that were done during this quarter that also supported some of the write-offs that we finally did during the quarter. So even with these, we finally finished with overall lower cost of risk in retail than 1 year ago. But truly, as I already mentioned before, both in mortgage, but also in other retail. For example, in other retail, which is typical, essentially cash loans, not only, but essentially cash loans, we have an average cost of risk close to 200 basis points. Right? So sometimes it goes a little bit up and down, but on average, let's say, is around 200, and this has not changed also significantly in the recent past. In corporate, the same situation. We did not face any relevant deteriorations of relevant exposures that we had, so also it was a relatively benign quarter. So, you know, so again, there was nothing extra. I mean, it is a little bit lower than probably we were expecting, a little bit. But it's probably 6 basis points lower than what we would expect, right? Because I think that we were always thinking about is around 50 basis points. And again, as I said, we are still very fresh from this initial adjustment of IFRS 9. So I think for you to take proper conclusions, I think we need 1 or 2 quarters more. You need to compare with every bank, all the banks, because I think this is also important to see, because each one does according to different methodologies but for now the situation really is I can say is benign for the current year.
And maybe just a follow up on net interest income. What was the impact of IFRS 9 there?
It was relatively small. It was less than 5 million zlotys. So what I wanted to, when I mentioned that, it was just to show that, of course, nominally we had a drop of NII versus the previous quarter, but if we add up these 3 factors, shorter quarter by 2 days, plus lower remunerations of reserves from NBP, plus this small IFRS 9 impact. I'm saying small for us, I'm not sure if it will be small for all the banks. This, in fact, much more than eliminates the drop. I'm not saying that it was a fantastic quarter in terms of NII, I'm just saying that it was not a drop if we take like for like NII, let's say, in this way.
So if I may maybe ask two questions still unanswered, because the other I think were answered already, which came from internet, following on NIM also, but more to the future. What NIM dynamics do you expect in the coming quarters and in the medium term, given the stable for longer interest rates? So some forecast for NIM and NII.
Yeah, so first of all, I should remind that we never expressed the hope of having higher interest rates in the short term. So we never guided, we never hoped. So from this side, no surprises for us. Even I can tell you that we budgeted the year with flat interest rates, so I think it was a good budgetary decision for us, that we were not counting with the support of higher interest rates to make our budget for the current year. Having said that, and despite this small drop of NIM on a quarterly basis, although it's still higher than 1 year ago, structurally we would expect NIM to go up. If everything that we are doing will deliver the results that we expect, through time NIM should go up, because on the asset side we are changing the asset mix, especially growing higher yield loans, especially consumer loans. In mortgage, we are replacing lower margin mortgages by newer, higher margin mortgages in PLN, because the average spread of the FX mortgage book is much lower than the new origination that we are doing in PLN. So this is also accretive for NII, as time will go through. In corporate, where we always said that it's more difficult, that there is a lot of competition. It's true, but the spreads are not deteriorating versus what we were having. So from the asset side, this should be supportive. Second element is securities portfolio. From this side, I would say this year is relatively neutral. We have average yield on our portfolio that we were already having in some of the previous quarters. So I would say that here it's more a volume effect than anything else. And the third is from the deposit side. We had a downward trend of the average cost of the deposits, which now was temporarily interrupted in the first quarter, mainly due to this impact of interest costs from the savings account campaign. But we see this. We are not obsessed in correcting this trend, okay? So I'm not promising that next quarter we already will show a lower average cost of the deposits, but we know that this gradual change in the deposits mix with higher share of current accounts and savings accounts in total will lead us to have average lower cost of deposits, or better saying, average higher margin on the deposits. And so if through time the combination of these effects should translate into an increase of NIM if interest rates will not be cut.
Thank you. Thank you. And one more question from internet, also from JP Morgan, about commission fees. Yes, can the 2% quarter-on-quarter fee income growth continue for the rest of 2018? If yes, what are the key drivers?
So here I need to remind that usually we have a very good first quarter. So the first quarter is not exactly the average of the year. We have some fees that concentrate in the first quarter. So we cannot say that the next quarters in terms of fees are going to be higher than the first quarter. What we think is that on a structural trend way, we will have year after year higher fees than in the previous year. So our focus is not beating on a quarterly basis the previous quarter or whatever, but it's rather to every year after year to show a sustainable pace of growth of overall fees and commissions. Most of the things are controllable by the bank. What is volatile in the overall fees and commissions of the bank are the part connected with capital markets, especially the fees that are coming from investment products, which are subject to the mood and to also the net inflows to the funds. And to a lower extent, some other regulatory things that happened in the past, such as interchange fees, but we are not now thinking about anything special to happen in the near future. So most of the flow of commissions is relatively, let's say, stable. So I would say that structurally we also expect through time and with the growth of the business, transactions, of customers, we expect also fees to follow that business growth.
Thank you. There are no more questions via internet. Are there any from here, from the room? I don't see. So thank you very much for participation here, and see you after next quarter conference. See you or have you via internet present with us in July. Thank you.